Welcome back. Let's talk about one of the most important controls companies perform to safeguard their cash from fraud and errors, and that's the bank reconciliation. Before we get started, please look over in our class website to be certain you've printed or reviewed the documents I posted for you that help explain bank reconciliations. The bank statement is a document prepared by the bank every month that reports your beginning and your ending balances, and all receipts, these are called credits, and payments, these are called debits, processed by the bank during the month. It's a record of what the bank thinks what happened in your account during the month. A bank reconciliation will identify any errors that need to be corrected by you or the bank. Bank reconciliations are important because the bank balance on the bank statement almost never agrees to the balance shown in the company's general ledger, also called the books. Why are the bank statement balances different from the general ledger cash account balance? This is usually due to information that one party has that the other does not. We call these timing differences or reconciling differences. Let's look at how to prepare a bank reconciliation in more detail. When we prepare a bank reconciliation, there are two sections. In one section, we reconcile the bank statement to an adjusted bank balance. In the other section, we reconcile the general ledger book balance to an adjusted book balance. The adjusted balances in both sections should be equal. Let's look at the reconciling items in more detail. Now, to repeat, there are two sides to a bank rec, and both sides will total the same adjusted balance once we're done. On the bank side, we will start with the balance on the bank statement and adjust it for deposits in transit, outstanding checks, and errors made by the bank. And on the book side, we will start with the cash balance in the general ledger and adjust it for collections made by the bank on our behalf, interest earned, customer checks that were drawn on accounts that were non-sufficient. Those are called non-sufficient funds or NSF checks, bank service charges, and errors that we made. Examples of collections made by the bank on our behalf would be when we direct the bank to process our customer payments for internal control reasons, or when the bank collects a note receivable for us from a customer. Please pay special attention to the comment in the arrow. Only the items that reconcile the book balance require adjusting journal entries to be made. Those are on the left side of this list. Now, I provided this slide to explain a common misperception about bank debit and credit memos. In short, banks think about things in just the opposite way that we do. Just remember the rules you learned about debits and credits, and remember to think about the bank account as an asset. It always increases with debits and decreases with credits. In reality, the bank accounts for a company's bank account as a liability, an amount they owe to the company. As a result, the bank sees increases in the bank account as increases in a liability to the company, and the bank therefore issues credit memos to record them. Their terminology is exactly opposite the way the company's is, but it should all make sense to you after thinking this explanation through. The quick check on this slide is taken from the quick study exercises at the end of the chapter. Can you answer the questions? The way I think about reconciling items is to ask who knows about it. If the bank knows about a transaction and has included it in the bank statement, then you don't have to put it on the bank side of a reconciliation. But then it's likely that the company does not know about the transaction and must include it on the book side of the reconciliation and also prepare an adjusting journal entry. Remember, any reconciling item on the book side requires a journal entry. So let's consider bank service charges. Who knows about them, the bank or the company? The bank clearly knows about its service charges, so they must be deducted from the general ledger balance on the book side of the reconciliation. Here's another example. Who knows about outstanding checks, the bank or the company? Outstanding checks are checks that were written by the company, recorded in the books, and given to vendors, employees, or other payees. Those checks are still tucked in somebody's pocket or desk drawer. They haven't cleared or reached our bank account yet. And the bank doesn't even know they exist. So does it make sense that outstanding checks are reconciling items the company knows about, but the bank doesn't? We must deduct them from the bank statement balance on the bank side of the reconciliation. No adjusting entry is required because we have already reduced our general ledger cash account when we wrote the checks. We are going to use Simmons Company here and provide it in your handouts to illustrate preparation of a bank reconciliation. I recommend you pause the video and pull out the example to have a look while we talk about the information. As we go through the illustration, I recommend that you take notes and prepare your own copy of the bank reconciliation. In accounting, you actually need to do the work, just not be listening to it. Take a minute and read over these items before proceeding. And as you read the items, determine whether each is a bank reconciling item or a book reconciling item. Mark that in your notes before we talk about them. There's no better way to learn than to try something, come to a conclusion, then discuss whether or not you had it right. The first step is to list the facts from the bank statement and the general ledger, the books. Now again, I challenge you to pause this video and prepare the bank reconciliation. Remember, the adjusted bank balance and the adjusted book balance must be the same when you finish. The format is here on the screen and also in the textbook to give you a solid start. So give it a go. Let's have a look at your work. We'll start on the bank side. Which of the items in the list of reconciling items belonged on the bank side of the reconciliation? Which items did the bank not know about? By referring to your notes and asking the who knows about it question, you should have picked out number 1, the outstanding checks, number 2, the deposit in transit, and number 6, the bank error. That leaves the other items, number 3, 4, and 5, as reconciling items on the book side. As a tip, I usually find it easier to reconcile the bank side first because there are fewer items to think about, usually just deposits in transit, outstanding checks, and sometimes a bank error. So let's plug numbers for number 1, 2, and 6 into the bank side of the reconciliation. First, identify and record the bank balance at the top of the bank side of the reconciliation. That's $9,610. Next, consider the reconciling items. Item 1, we talked about outstanding checks already. These will be treated as a deduction from the bank balance of $2,903. Item 2, deposits in transit are similar to outstanding checks. Suppose we received $500 from a customer on July 31st, but we worked late and had to use the night depository or the ATM machine at the bank because the bank was closed when we got there. We will record the cash as a receipt on July 31st in our general ledger, but the bank won't record it until they open for business and see the deposit. And that's in August. A perfect example of a timing difference. We have to add deposits in transit to the bank statement to reflect the fact that we have the money, even if the bank doesn't show it on their statement. And then item number 6, in this item, the bank gave us $486 by mistake. Oops! Free money is good, but this isn't our money. So we will deduct it from the bank side of the bank rec and contact the bank to ask them to take it out of our account. That is, if they haven't already figured out that they made an error. And after adding the deposit in transit and subtracting the bank error and the outstanding checks, the adjusted bank balance is $7,207. Let's see if we can make the book side balance to the same amount. Identify the company's book balance of the cash account, that's $7,430, and enter it on the book side of the reconciliation. Next, figure out what to do with the reconciling items number 3, 4, and 5. Item number 3, non-sufficient fund checks are checks that bounce when you deposit them. Your customer did not have sufficient funds to pay you. In this case, you find out by preparing the bank reconciliation that a deposit you made of $225 isn't really valid, so now you have to subtract it on the bank rec and make an adjustment to remove it from the books. Item number 4. The bank statement also shows a credit of $30 for interest earned on the average cash balance. There was no prior notification of this item, and it is not recorded in the general ledger. Therefore, we treat it as a reconciling item and add it to the book balance on the bank rec. And item number 5, it appears as though Simmons made an error when they recorded a check for supplies. The company recorded only $240 for supplies, but actually wrote the check for $268. Think this through carefully. Draw a T account for cash to help you picture it. The company took out $240 from the cash account, but they should have taken out $268. So don't they have to reduce the book balance by $28? Are there any more hints? Nope, looks like we got them all. So you total up the bank side of the reconciliation and wahoo! The adjusted book balance equals the adjusted bank balance, $7,207, but we're not done yet. A bank reconciliation often identifies unrecorded items that need recording by the company. In Simmons' reconciliation, the adjusted balance of $7,207 is the correct balance as of July 31st, but the company's accounting records show a $7,430 balance. We must prepare journal entries to adjust the book balance to the correct balance. It's important to remember that only the items reconciling the book balance require adjustment. First, we debit cash and credit interest revenue for the amount of interest earned in item number 4. Second, we debit supplies expense and accounts receivable and credit cash. The debit to supplies expense is to correct the error we made earlier in item 5. The debit to accounts receivable creates an account for the amount of non-sufficient funds check the customer gave us. That was item 3. This debit to accounts receivable indicates that the customer has not satisfied the account. And after posting these entries, the balance in the cash account is adjusted to the balance on the bank reconciliation of $7,207. I hope this chapter was interesting and practical for you as you think about your business career. The topic of internal control is one that many students can relate to. In Chapter 7, we will learn more about receivables. See you soon.